was a strong and friendly fella with the name of Campanella. He was someone special, I could see right off the bat. There was something.
Webcasting from the Little Bell Publishing Studios in Rockton, Illinois, this is the Mortgage Messenger with host Jim Campanella. Welcome to the Mortgage Messenger for the week ended June 18th. Happy belated Father's Day and welcome to the first day of summer. So why don't we begin? And now, the week in review. Last week, the indicators all showed that inflation is running at about a 0.9% annualized. Now, the government likes to see it between 1.5% to 2%, so this is actually very low. The lowest it's been in 40 years, 4 decades. So we're going to be keeping a close eye on whether or not the government the feds shift from worrying about inflation to worrying about deflation, and that's where values decline. That's actually worse than inflation. The other thing we're watching from that developed last week is going to be the extension of the home buyer's credit. Currently, it expires on June 30th. If you purchased a home or was under contract as of April 30th, you had till June 30th to close on the sale in order for you to get if you're a first-time buyer, an $8,000 credit, or a pre-existing buyer, a $6,500 credit. The Senate has now passed a bill to extend it to September 30th. You still had to be under contract by April 30th, but they're giving you more time to actually get to your closing. That has not yet been passed or signed by our president, but it is something in the works. It's something very good in the works, and hopefully it'll make it through the House and signed by the president before the June 30th deadline, giving everybody a little more time to get their loans closed. Coming up this week, we have the Fed meeting in the middle of the week. We also have existing home and new home sales coming out. Again, anything can cause our rates to go up at this point. They are certainly at very low rates now, so any news that comes out contrary to where we're anticipating could cause rates to take a bump upward. Again, this week there's a lot of comments at the website about the blog and everything else, but no real questions. So I just wanted to address a couple issues while I can here. One, of course, you can follow us on your iPhone with our new iPhone app. You can find that by searching Mortgage Messenger. And two, of course, if you own a Kindle, you can subscribe to the service through the Kindle service and have us every week there too. Last week, on Wednesday, we talked about how to obtain your free credit report. We do have a couple of video blogs coming up now, what to do with that credit report and how to read it and analyze it. So if you have not pulled your credit report, completely free if you follow the instructions in the previous blog, last Wednesday's blog, you want to do that. It's your right to see what's on your credit report, so you should certainly pull your credit report and see what's on there so that you can now begin to take the steps to correct anything that may be incorrect or inaccurate. So again, go to the previous blog about the credit report and see how to obtain your truly free credit report from the government. The other thing we're going to be following closely, and I just wanted to bring everyone aware of it, because now that we're in the summer buying season, this is the time that most people are buying homes while the kids are out of school. They all want to be in their new homes before school starts back up, is some of the proposed changes to FHA. FHA has become a very active program, although it's been around since the 1940s. It was a shelved program. It was really just geared for first-time buyers previously. Now it's a big product for all of us to use because of the lower down payment and very good interest rates, and a little bit looser credit score. But they're now proposing, or one of the changes that I've just read about, would be proposing a change in the MIP, the mortgage insurance premium. We've already had one adjustment recently, making it a little more expensive to obtain an FHA loan. And with this new proposal, it's being reported that if you were to get a 5% mortgage, 30-year fixed, great rate, the way the proposal is written, the effective rate with the new MIP would be that you're getting a 7% loan. Still 5% on your note, but with the added mortgage insurance, it would be equivalent to getting a 7% loan. What that means, not only is it more expensive to get a mortgage, but it means you're going to buy less house. Because if you're trying to keep your payment at, say, $1,000 a month, at a 7% interest rate, you're going to be able to afford less of a house. So that's going to slow up our recovery, because it's also going to slow up the appreciation in home values, because people are just going to continue to be pushed down into the value. So that's something that people are closely watching. It's only a proposal at this point, but if you are considering buying a home, especially if you're considering buying your first home, you may want to be looking at that sooner than later, before some of these changes take place. Well, I can tell by the clock on the wall outside the studio window that our time is up. Again, should you have any questions or comments, you can visit our website, www.mortgagemessenger.net. You can drop me an email, or if you have an iPhone, you can send a message right from your phone. And until next time, thank you for viewing.
Forget you, Campanella. You're still the MVP within my heart. You're still the MVP within my heart.